Alright guys, welcome back to the channel. I haven't been posting as much as I would like. I do want to change that, but my schedule is a little bit nuts. It's a little bit off the chain. So no promises, we'll try our best. Today's video is pretty interesting. You might have clicked on it for the title. We're going to talk about that. We're going to talk about a lot of other things. This video might go a little bit long, but I'm also monitoring a sleeping baby on a baby monitor, so if you do hear some crying, I'm going to cut the video short and just go tend to that. Probably won't come back. We'll just end it when it happens. If it doesn't happen, this could end up being a long video. Don't get a chance to record often, so I do like to dump as much information in these as I possibly can. Today's video is pretty important topic. If you are interested in business, if you're interested in investing, if you're interested in real estate, any of those topics, today's video is going to apply to you. And basically, the header of this video, the title of this video, will be something like, why do big corporations not own land? Why do large multinationals choose to lease land often instead of owning it outright themselves? A really big example of this, smart centers. So I'm just going to check. I know the stock symbol is SMRT. Smart rent. No, that's not it. Smart Centers REIT. I'm doing this live. So on the Canadian Stock Exchange, the Toronto Stock Exchange, SRU.UN is a REIT, a real estate investment trust called Smart Centers. Now, if you're familiar with Canadian real estate, commercial real estate, or Canadian Walmart, the Canadian branch of Walmart, you've probably seen the signs of penguins around, and this is Smart Centers. So a company which invests primarily in real estate and tries to get a return on real estate, mostly through dividends, paying shareholders of the company a annual dividend or a quarterly dividend. It's called a real estate investment trust. So just like if you're familiar with mutual funds are these investment corporations, which used to be called investment trusts, but they changed the name to mutual funds at some point in the past. And essentially the goal of a mutual fund, and this will make sense why I'm explaining this later. The goal of a mutual fund is to get a return for its shareholders. So imagine you start a company, sole purpose of the company is to get a return on investment. You're going to invest in large, safe companies with the money that your investors give you, and then you're going to pay dividends to them, and hopefully the shares of this company that invests in things go up over time. So as long as it's a public, sometimes there are private mutual funds, but almost always they're public, so almost anyone with an investment account can buy mutual funds. You don't need to necessarily go to a special person, but often they are sold through brokers. So the point of me telling you this is mutual funds came to be as an easy way to invest your money actively in different companies. The mutual fund takes care of the investing side. So instead of you having to go buy shares in companies, stocks, things like that, a mutual fund does that for you. So when a company is not performing very well or it's near the bottom of the pack, the mutual fund will take care of selling those shares for you. And they do this for all their shareholders equally. So everyone owns a very small portion of this large pool of funds that's kind of moving around. It's the exact same thing that happens with pension funds. It's the exact same thing that happens with, if you've ever watched The Irishman, Jimmy Hoffa, this movie about unions. So union funds were like large chunks of money because the union dues are constantly being put in. And where do they put their money? They invest it. They don't just pay the money out every month like you would think. They actually take the surplus and invest it. So this is the same thing that real estate investment companies do. They're trying to earn a return on investment for their shareholders, but they only do it in real estate. And there are very specific rules for real estate investment trusts. So you have to be earning the return through rent, through through income earned. And I'm going to flub the exact. If you want to learn more about REITs, read up on it, buy some books, read up on it. But REITs are really interesting because 90% of the earnings will be paid out through dividends. That's by law, they're required to do that. Whereas a company could choose not to have a dividend for years and years and years. Real estate investment trusts are a lot more legally obligated to pay out in form of dividends. So instead of trying to expand the real estate investment trust, they have a very small amount of money to do that and move it around. They have to be paying out almost all of it in dividends. And the stuff that a real estate investment trust owns is limited as well. They can only own, real estate. It has to be earning income on the real estate. They can't be flipping properties, for instance, because that would be earning it through the sale of properties rather than like through the traditional means of renting it out. So that's a brief explanation of real estate investment trusts. So why do I bring that up? Well, a real estate investment trust, and there are exceptions to this, but typically they don't earn a crazy return on your capital. So just for example, I've pulled up SmartCentres. So this is a Canadian real estate investment trust. It's commercial, and it has a market cap of just about 4 billion Canadian dollars. It has a dividend yield of 6.73%. So that's the yield on, currently the stock's hovering around 27.5, and it fluctuates, every day. It's down a little bit from its highs last year, around $33 per share. Right now it's 26.5. So the yield at the current price is 6.73. But again, you're not expecting much appreciation on this. You're not expecting, like a company, you're not expecting a 6 or 7 or 8 or 9% growth on the stock, because all the profit gets paid out in the form of dividends to the shareholders. So if you're willing to get a dividend yield, which I'm not squawking at 6.73%, that's a great return, by the way. But if you're getting a 6.73% dividend yield, you're not growing the company at a crazy rate. It's just not going to happen. It's not sustainable to grow your company while also paying out, almost all the profit in the form of a dividend yield. And because of the laws around REITs, we know what the net profit of this company is pretty much, because again, 90% of it has to be paid out in the form of dividends to shareholders. So why do I bring this up? Well, why would a company want to own their own real estate when the very, very best companies of the world are only earning like a 6.7% return on their real estate? So why would a company willingly take on a 6.73% return on their investment when the company itself earns a higher return than that? And that's the question you need to ask yourself. So we looked up the SmartCentres REIT. Now we're going to look up the Walmart. So the Walmart stock, and this is should be on the New York Stock Exchange. And it is. It also pays a dividend, but it only pays a 1.54% dividend. The market cap's obviously much, much larger, but in the last year, the stock has moved quite a bit. So, the last couple years have been pretty traumatic for shareholders of all kinds, for stockholders of all kinds. But with a stock, you should typically see an appreciation over time, because the company is becoming more valuable, more profitable, keeping more of the money, becoming more competitive, lowering costs, growing revenues. And just, by virtue of the fact that Walmart has a $400 billion market cap, and SmartCentres only has a $4 billion market cap. Now, given SmartCentres is much, much smaller because it just operates in Canada, right? It's a Canadian REIT. But given that SmartCentres basically own all of the Walmart real estate, just think of the magnitude. Imagine Canada is 10% of Walmart's business, because Canada is about 10% of the population of the US. That should be about a $40 billion market cap for Walmart in Canada itself. That's 10 times the size of the SmartCentres market cap. So imagine, owning a share of SmartCentres in perpetuity until the end of time forever will only ever be worth about 10%, according to the market, will only ever be worth 10% of what the Walmart stock, similar value, the Walmart stock will be worth, because Walmart has much greater growth prospects and much greater, capacity for profit. So about 10 times the market cap means about 10 times the value has been invested in the company. Even though the dividend yield is lower on Walmart, we know that it's because they're reinvesting a lot of the money. You don't buy a stock like Walmart necessarily for a stable dividend, though it will pay a very small dividend to keep, investors interested. It's probably going for growth. Like Walmarts are opening all around the country. They're reinvesting a lot of the money. They're trying to beat out competitors, etc. Would it be smart for Walmart to buy the real estate that they own or the real estate that they operate on and plow, a tenth of their business into their real estate holdings? I'm actually not sure. For every company, it's going to be a little bit different. But this is just to give you a perspective on Walmart as a business is much, much more valuable than all the land it actually operates on. You've probably heard conflicting things about this. For instance, like McDonald's, McDonald's, they open their locations as an excuse to own the real estate. I can tell you that that's just not true. The dividends that McDonald's is earning, the money that McDonald's is earning is, much, much larger than all of the land would be earning as a dividend of just the land itself. Like if whatever you're able to rent out the land that Walmart's or McDonald's operate on, it's going to be a very small portion of what the total profit of what that Walmart or McDonald's are earning. So the idea that Walmart would invest money in the land to earn a smaller return than they would if they reinvested that money in more Walmarts or more McDonald's, owner-operators, opening new stores, whatever, it just doesn't make business sense. You want to put your money where you're getting the highest return. So the first kind of bullet point that I would say is the reason that corporations tend not to own their own land is for cost savings. So it's more cost effective for them to lease the land, to rent the land. From a perspective of their stockholder, from their shareholder, it's better for them business-wise to rent the land because they know, we're going to pay whatever the rent is, but, if we owned the land and saved the rent, that would actually cost us money in the long run because we could have earned a greater return just doing what we do better, which is operating retail stores or restaurants in the case of McDonald's. Another reason corporations love to lease instead of own is the flexibility that it offers. So this is, kind of brutal. Business can be pretty brutal. I remember reading Peter Lindman wrote a really, really good book called Real Estate Investments, Risks and Opportunities, something along those lines. You can find it on Amazon. Really, really good textbook. The guy teaches at, high-level American University, real estate, and just a really interesting read if you got the patience for it. But one of the things he brings up is these ghosting, like large corporations will sometimes ghost their landlords. They'll sign these long leases, and Walmart's actually known for doing this. If the retail location that they're operating out of becomes less favorable for whatever reason, like let's say just for whatever reason the city decides to move a different direction. If you're in Sudbury, this will make perfect sense to you. We actually have Sudbury itself proper, and there's another town right beside it called New Sudbury. There's a large conservation area between the two, so it's created like this false dichotomy, division of the cities. So there's actually two Walmarts, there's two of everything, one in the New Sudbury, one in the Old Sudbury. It's not called Old Sudbury, but that's implicitly what it would be. And Walmart decided, just to open up another one. But let's say in the case, in Sudbury's case, to use it as an example, I'm talking a little bit fast, I'm sorry. To use Sudbury as an example, let's say people started moving out of the older part of Sudbury. The Walmart was not getting as much traffic, and it was time to close it down. Well, instead of paying out the lease, riding out the lease for 10 years, or instead of owning the land and having to suffer a loss on that land, which would cut into the profits of their business, they will just go and lease another place and open the new Walmart, like down the street or across town, whatever, and just leave that other Walmart empty, continue paying on the lease, like the bare minimum payments paying on the lease, in order to prevent competition from entering. So because they don't want other big box stores, other grocery stores moving in to compete with them, they'll just keep leasing that place, and they probably had a good rate, but it has to make sense business-wise for them to do that. But if they own the land, it would be much, much harder to do that. It'd be much, much harder to find the flexibility for the length of use, the cost of use. The ability to change locations is greatly improved if it's just a lease, because you don't pay necessarily the value of the land over the entire value of the lease. Like if the land, this is hard for people to understand as well, but if the land increases in value while you're operating on it, that might seem like a lost, revenue for your business. Like if the land's appreciating, wouldn't it be good to own it? Well, it's probably not appreciating as fast as your business is profiting. Like in the case of Walmart, a regular corporation might profit 6 or 7 or 10% per year. Real estate appreciation above that rate is abnormal. Like it's pretty rare actually that you get that appreciation. So let's say 1 year you do get it, 10 years you're not going to get that appreciation. That means it'd be better to reinvest the funds into your business and get that 6, 7, or 10% return rather than hoping that 1 year you're going to get 5 or 6% return on the actual land. And that essentially, like it Wile E. Coyotes your business with an anchor tied to his ankle over the edge of a cliff on a year when real estate is significantly down. Real estate is just unpredictable, like stock prices, like anything else. It's very difficult to predict where things are going to go. We can try, we can, look at the macroeconomic data, but at the end of the day, nobody really knows what's going to happen in any specific market for certain, and corporations like to stay out of it. So those two are kind of a 2-in-1, and that would be the flexibility that corporations get by not owning the land themselves, because they can either leave the location, they don't have to bother selling it, they can just keep renting it, prevent other people from coming in, other competitors from coming in, and get a higher return in another location while keeping competition out. So that's pretty cool. The other thing, if you own land, you can get screwed. And this kind of ties into the flexibility thing. I'm going to look at my notes a little bit here that I've written down in advance. But, having a lack of control of your property is not good. And landlords in Ontario will understand this perfectly. So you don't have complete control of your property. Even though you own it, you own title to it, you own the right to use it, to enjoy it. You don't own the land. And the government can change whatever rules at whatever time they would like. So if you own the land, you are subject to those rule changes, to the whims of government. If you're just leasing the land, you don't have to, live with those consequences. You can just simply move. The only risk that you take, just like with an option or any other extrinsic, financial instrument, with using time, is you can just leave and then pay whatever the lease is, whatever. That's your highest risk that you have, is your lease and whatever revenues you would have earned had things gone better. But the government is a huge vector of risk for businesses. Large corporations are no exception. In fact, usually risk is much, much larger for large corporations. Just imagine the government decides, and this has happened in jurisdictions before, all the signage for all the companies must adhere to these rules. Like I know in Vermont, this is a legit rule. The whole state has rules on signage and how big signs can be and things. And what, highways, for instance, like how highways can be set up. That could really impact your business if people don't know where it is. If it's more of like a convenience thing that people just see the signs and come visit. If the government changes the rules on that, you might need to move your business. And if you own the land, suddenly, because it's become, less profitable, the land becomes less valuable. You lose all this money. It might be difficult to get rid of that land. You might have to take a loss on it. Zoning restrictions, other legal requirements, like by big business, just like with anyone else, they have to be followed. Obviously, we could talk about government corruption and politicians another time, but large corporations are really, really paying attention because they can really get slapped hard by government like a small business person, really would never be. So if you're just operating like a mom and pop shop, the worst that can happen is like the local government gets mad at you and, you lose your restaurant. But a large corporation, like this happened recently with some of the drug companies, and, in the last 20 years kind of thing, the drug companies are the largest, have been subject to the largest fines in corporate history for some of the misdealings that they've done. So like paying $40 billion or whatever out of the accounts of a large business, that's a lot of money. $40 billion. That's something a mom and pop shop would just never have to pay. And the shareholders of a mom and pop shop would never have to lose that kind of cash. So that's another reason, is you just never know what's going to happen. There's a lack of control. Everywhere in the world, there's a lack of control subject to government whims. And if you own the land, you, like it or not, are subject to those things. And the final one that I'll go over is tax benefits. And this is something I'm not, admittedly, I'm not a tax expert. I would consider myself a real estate investing expert, but not necessarily a tax expert. I've read a couple books about it. I've talked about this in videos before, but really seek out, tax experts if you want to learn more about the nuance of taxes and things. But leasing sometimes offers benefits in the form of taxation. Now, owning land also does, give you tax benefits. Obviously, these corporations a lot of the time will own the building that's on the land as well, which means they benefit from depreciation and tax write-offs to do with the building. But land itself is not depreciable. So if you own the land, it doesn't necessarily give you a tax benefit. Whereas if you're just leasing the land itself, but you own the building, you can still benefit from all the tax write-offs and depreciation that the building would afford without owning the dead weight of the land itself. If that sounds crazy to you, like why would you buy the land itself, build your own building there and do this? Sometimes we're talking about 20-year, 50-year, 100-year leases where, there's no risk of the landlord taking back the land because it would be too large of a legal penalty for the landlord to evict the tenant, like a Walmart or a McDonald's or whatever. And I know McDonald's is the exception because they actually do own all of their own land, but that would actually be considered a dead weight. Okay, just to summarize, let's end the video on a good note, and that is, if you run a very profitable business, maybe consider selling the land. It's a dead weight that you could do without. Land itself, especially commercially zoned land, is typically pretty expensive, and the money that you could get out of selling the money you could get out of selling that land could be reinvested in your business to get a much higher percent return, even in an unleveraged scenario than your land could. And, for all the benefits of real estate, for all the amazing things that real estate can do to build your wealth, build your portfolio, the leverage that you can enjoy, we could talk about this all day, all night. Businesses simply earn a higher percent return. Well-run, well-executed businesses simply will earn a larger return on scale, at a large scale. And that's something that's very difficult for real estate companies to overcome. So if you want to invest in real estate, look at real estate investment trusts. Don't buy McDonald's. If you want to invest in land, buy the brand, buy the fast food chain. If you want to invest in Walmart, invest in Walmart itself, the business. You're not investing in land. You're not investing in large plots of commercially zoned, / industrial warehousing in various parts of the country and the continent. You're investing in the business itself, and that's the way it should stay. This is my opinion on this. If you're running an efficient business, you have no need to also own the land. You can just lease the land. It gives you all sorts of benefits, and it's usually worth the hassle just for the cost, the tax benefits, everything we've gone over. To end this, if you enjoyed this video, subscribe to the channel. I'm going to try and upload more videos like this when I have more time. And I'm Zachary Ireland, obviously always open to talk about real estate. I'm going to leave a link to our website in the description if you want to get in touch with us, invest in this local market from anywhere in the world remotely, or especially in Canada or the US. We can fly you out here. You can take a look at some properties yourself, pull the trigger on one, and it's a really, really good place to invest. See you guys in the next one.